everyone. Apologies, a little late today. Let me get this out of the way. So, good afternoon to everyone. This is a topic that I wanted to cover for a while now, and it's a topic that uh, I was trying to get live and explain. I think last week or 2 weeks ago, but there were a lot of technical difficulties. Ideally, now everything sound is good, everything is good, and we can jump right into it. So in today's session in this webinar, I want to talk about specific strategy, specific strategies that have been floating around, and um, it's smart money concepts. Right before I jump into that, I want to put out a little disclaimer. These aren't necessarily strategies that I have anything against or that I use personally smart money concepts, right? I've done a lot of research on it based on the most recent popularity that's come out, right? That's mainly what I want to talk about because they become extremely popular realistically, and I want to see what the fuss was about and see what the actual validity in that is, because I think it's important as a trader or as someone in the markets in a short-term perspective to go through things, especially that have gained popularity, and see if there's any real alpha or edge in them to kind of provide some insight, right, into that manner. So, with that being said, right, let's dive right into this. Smart money concepts, as a lot of you might know them, or right, they've been known to go by many different names realistically, but it's a trading strategy that's emerged over the last few years. Specifically, the last two, I would say. I think it's grown a lot over the last two. It's become immensely popular, realistically, in the world of trading, and developed honestly something of a strong cult following behind it. Right now, I'm not here to name names or talk shit or do any of that. Right, I just want to look at the system from an unbiased perspective and see if we can find an edge in it, find some alpha, or if there's holes to be poked in it. I'm also going to compare this to something that I know very well, so a system that I trade on a daily basis, and you can see it's littered all over this YouTube channel. It's generally something that I look at as auction market theory, Wyckoff theory, if you will. Some systems that are generally concentrated on balances and volumes. So if you guys have questions about this all throughout, just let me know in the comments, and I'll take a look at those. Hello, everyone. Hope everyone's doing well. We'll take a look at not only the smart money concept, but we'll take a look at the market as well, because everyone's like, geez, it's been slow, it's been grinding to the upside. So the question is, can smart money concepts trade or be traded, be used in any market condition in comparison to something that I think has validity in any market condition? So this is a perfect time to do that because markets are slow to the grind side, right? They've just been rallying aggressively, and being very choppy realistically. So, can we take the principles from smart money concepts, apply them to any market condition, or are we going to have to look at something different, right, in terms of auction theory? So, the main premise of smart money concepts, right, is that the hypothesis that they hypothesize that market makers, including institutions, which are banks, hedge funds, big funds, whatever they are, play a deliberate role in complicating trading endeavors for retail traders. So this system, right, evolve or revolves around the idea that the retail trader is pretty screwed by the bigger institutions purposefully, right? There's an algo, quote unquote, that runs this and beats up the little guy, right, purposefully. So using SMC, traders are generally told that they should create and construct their strategies around the activities of what we would call smart money, right? Effectively unscrewing themselves. So the whole premise of this strategy and system, from what I've understood over the things that I've read and experienced online over the past few years, is that if you understand how the smart money screws you, right, and apparently there are specific indications or systems around it, if you understand how they screw you, you can effectively unscrew yourself by playing against them. So this is, from the start, for me, it sounds a little more, I guess, conspiracy theorists, and I'll explain why. These concepts and these practices are generally used in the world of Forex a lot, but they've recently been applied to other assets, specifically futures. The futures market has seen a massive uproar in recent SMC or ICT traders, whatever the case might be. So, when you consider Forex, first of all, it's a market that has no centralized exchange, right? So that means that there's no there's no one specific exchange that shows you all of the volume is what I'm trying to say. Because if you go and trade futures, right, the CME provides all the data, the order flow, the volume that comes into the market, so you can make an informed decision based on literally all the flow that you see. If you're with a forex broker, right, forex brokers typically have A and B books, but forex brokers, they only show you the volume that is projected inside that forex broker, right? Generally speaking, the forex market is massive, volume's immense. So having all of that volume centralized into a specific area is not possible. However, I think that smart money concepts and the theory behind this strategy, they created this strategy in an effort to understand Forex from a different perspective, in my opinion. So, the first thing that sticks out to me is this statement, right? The concept that smart money is a thing and that smart money is out there to eat your stops, I think personally is a delusional concept. I think it's a delusional thing to think. The market is comprised of big and small players, right? Realistically, yes. Are all the players institutions? No, right? Are all the institutions market makers sitting there asking themselves, where is VIX stop, right? Where is whoever's stop? They don't give a shit about my 3 lot, my 4 lot on the S&P, right? They're not there to hunt your stops. They're not there to hunt the retail stops. Market makers don't sit around conspiring where stops are. It's just an unrealistic approach. Now, the other concept about this is that the smart money, the institutional players are what controls the whole system in its entirety. Is that factual? No, not necessarily, because again, there are multiple cases, but the main case that sticks out to me is Navinder Sarao, right? If you remember that name, he was accused of the 2010 flash crash from London, right? He was accused of spoofing the CME with E-minis, the S&P 500 E-minis, from his parents' basement. Now, based on smart money concepts, this shouldn't necessarily be possible, realistically. This shouldn't be a real concept if someone from their mom's basement is able to spoof the CME, right? So, again, a slight little hole that's been poked there. So, I discern the idea of smart money. I think that it's a kind of a fake concept that people sell you on, trying to find the smart money or blah, blah, blah. Rather than tell you that the markets move based on heavy or light volume and activity by the accumulation of large or small traders. When people ask you, right, why did the market move? Or who moved the market? Why? Was that a hedge? Was that a new position? It doesn't matter, right? It doesn't matter. It doesn't matter who opened the position, whether it was JP Morgan or whoever the hell it was, how big of the size it was. Was it a hedge? Was it a new position? Was it a stop? That's not of interest in the futures market because volume is volume. The order flow is the order flow. The reaction is the reaction. If someone comes in with a massive sell and they just spring it back up, right, you can assume it's a hedge or you can assume whatever the hell you want it to be. But the reality of the situation is that guy got trapped and you're most likely going to see a move higher. So your hypothesis is I start buying, right? So there are large and small traders. There are huge players that cause market moves, that's for sure. But I wouldn't call it smart money, right? You have following institutional money, all this stuff. But realistically, when you follow order flow, you follow the flow of big players that come in, whether they're 50, 30, 100, one big player, whatever the volume is, whatever the market movement is, that's what it is there, right? There's no necessary need to dive deeper into that. So just keep that in mind as you go forward and you look at these things and people try to sell you on the concept of smart money. So the second part that kind of bothers me about this statement, no institution, like I said before, is going to be looking at my stop orders or my orders in general, how I'm getting in or what I'm doing with it, right? The market looks at many different internals for big money. I'm not a trader that trades 100, 200 lots, so I don't have to sprinkle or I don't have to get in specifically with icebergs and whatnot. So they're not looking at that retail size realistically. Like I said, the market looks at many different internals for big money players, for the big movers, right? They have key levels they get into. Uh, they might need to just get in based on the end of day, right? Client needs to get in, whatever the case. Uh, they're forced to get in. They have a certain quota to fill. There's multiple different reasons. There are multiple different internals to look at. Maybe market's extremely oversold based on whatever indicator they have. They have to get in. Blah blah blah. Right? There's a bunch of different reasons. They run stops. They reverse areas, um, and realistically, the concept of them gathering together and gathering all the information from retail traders and watching them if they're long or short and whipping out those stops is kind of a stretch, right? Big money, if they're going to make a move, they're going to make a move. They don't care whose stop is where. They don't care what positioning size is where, right? They're going to go in, they're going to do it. And the best that we could do realistically is be able to identify where that positioning is, how they're positioned, and ride the wave, right? That's what retail does. That's what we're here for. One thing that I do agree with this within this statement is, right, is large market participants, right, or strong-handed traders have influence over market movement, right? And they tend to create large moves. This is something that stays consistent with all trading systems realistically. Like if Jimmy from JP Morgan wants to buy 1,000 Lonnie icebergs in and it's a big buy, right? Realistically, you're going to get a reaction from that. It's a very consistent idea that demand outweighing supply is going to make the markets move up and vice versa. The key is identifying how they do it, where they do it, right? Which is something that auction theory, volume, order flow can explain to a higher degree, I would say. So with that, right, little quick introduction, I want to go through SMC, right? I want to go through the jargon and the vocabulary that comes with the system. And I want to take it from an unbiased perspective. Are there things that I agree on? And I want to compare it to actual volume theory, auction theory, and how that kind of sizes up. And the main thing, I'm going to go through three of their main concepts, right? Order blocks, fair value gaps, and liquidity. And I'll go through the definition and see if it makes sense, right? From the perspective of let's say order flow, right? So these three metrics, right? You guys keep pushing in those questions. I really appreciate it. I'll go through those at the end. But I want to go through some specific things at the beginning, right? I have the futures market here in front of me. I have the S&P 500 futures market with live data in front of me. So I'm going to be applying these concepts, if you will, and this understanding to this chart, this market. So there's a few different things here, right? I want to pull up a specific chart first because there's something that was coded based on fair value gaps that kind of made me giggle, but it's important to see. But we'll go through order blocks first, like what order blocks specifically mean, does it make sense, right? So on and so forth. So the order block, right, from a definition that I found, it's a metric of supply and demand, realistically. So in smart money concepts, these are considered a more refined version of supply and demand. So I don't know how much truth there is into that. I know that there are supply and demand traders out there, and I think that supply and demand in itself, right, the concept of that is fine, right? You can start off with that, with the idea that a demand level is an area where you get a large move to the upside that generates, right? Same with supply. But the definition of an order block is a concentrated area of limit orders, right? Limit orders waiting execution, which is identified on a chart. So not only do you have limit orders waiting execution that creates this area, but it's also on a chart. Okay, interesting. Based on past price movement, right, is the start of a significant move up or down. So in essence, it's jargon for supply and demand, it would seem. Apparently, when a lot of buy or sell orders come together in a cluster, limits, right, it establishes support or resistance, which is able to absorb pressure and trigger price reversals. So, right, if we pick out the general concept of supply and demand, right, let's just say, okay, boom, let's draw something very quickly here. Okay, boom, this is a demand zone, right? You get a very nice extended move here from that area. The zone holds fairly well. Great, demand zone, fine. I don't mind that. You get a supply zone over here, right over here. You have some key areas, right? You flip-flop through them. I have no problem with that, right? These are just general support resistance based on supply and demand concepts. However, two issues with the statement that I said above. Number one, how are you possibly going to assume that there are limit orders clustered to enter the market based off a chart? That doesn't make any sense. right? Limit orders are going to be orders that are stagnant on a book, right? Whether it's on level 2, whether it's on a DOM, whatever the hell you want to call it. But limit orders, you can't see them clustered on a chart, right? It doesn't make any sense. Resting limit orders also, right? The second part of this, resting limit orders that don't fill because they're limit orders, if they're not market orders, they will not move price until price is somewhat close to them. Even then, they won't have that big of an area, right? They won't have that big of an area realistically. Like, if you have limit orders that are close to price, right? Maybe they might move something here and there, but if it's not a market order, it's not going to happen realistically. You can't absorb and turn a reversal based on a cluster of limits. That's just not it's not how orders work, right? So it's not that part of it, the explanation doesn't make sense to me. If you say, okay, there's supply and demand and actual market orders are getting absorbed that create these larger moves, we start to think about this from a more logical perspective. So if we keep the supply and demand aspect to this, right, we can call it an order block. Call it whatever the hell you want. It's fine. Next is the fair value gaps, right? Fair value gaps, or sorry, yeah, fair value gaps, right? By definition, this is what I found is an area where you have an expansionary move, right, that occurs in price at a specific time frame of your general choosing, right? This is an issue because if I'm trading on a 5 minute, 10 minute, hourly, they're going to be different concepts, realistically, right? These quote unquote fair value gaps. Based on the time frame, it's going to be different. So the fair value gap is a long extended candle, right? Where you take the top of the prior candle and the bottom of the third candle if it's bullish in that scenario, right? To identify this gap. So for example, let's see if we can find a massive green candle somewhere here or a massive red candle. So, uh, let's see. Let me see. There's not that many massive ones. Maybe we go to a 15-minute. Okay, so I guess something like this. This is a pretty big ass candle. So I would take the bottom of this candle, right? And then, okay, maybe we delete this and we make a new box. I take the top of the prior one, and then I pretty much take the bottom of the one after that. So this becomes like a fair value gap, if you will. Right. So this is our fair value gap. So we've drawn that. We've identified that as the opposite for a bearish move, realistically. Um, and based on the digging that I've done, the idea behind this is to fill the value gap, right? Fill it, complete it, before we continue in that direction. So as you can see in this case, right, we test it. Fine, okay, sure. We test it. We don't necessarily fill it. And then we start running or whatever it is. Um, so if I look at this, right, I want to bring to attention what Order Flow Leo had shown us here. So a friend from Twitter, right, he coded this based on fair value gaps. And this is the concept of it, right? This is a coded version of fair value gaps. I don't know. I think it might be on a 5 minute chart. So if you take a look at this, right, maybe I didn't draw it correctly. Like I said, I'm not very versed in the fair value gap world or whatever the hell it's called, because I'll tell you why. It doesn't necessarily make too much sense to me. But if you look at this, right, these are coded fair value gaps. The idea behind it, from what I understand, is generally you're looking for an area that creates an expansionary move based on lower volume, right? This is what you would call an unfinished auction if you talk about distributions and auction theory. An area where you have a quick move that creates an expansionary move, right? So that quick move is on low volume, and realistically what happens is that there's, I guess, quick traders, aggressive traders, right, confused traders, all these traders come together and they create this massive move. Generally speaking, when we talk about auction theory and what we have in terms of order flow and auction theory, when you have this expansive move on a low volume area, you'd want to pull back into it, right? Complete that move and continue higher. Now, if we claim that these fair value gaps are based on candles, you generate a chart that looks like this, right? That's like muddled with all of this stuff. So if you're going from candle to candle based on this realistically, it seems like way too over cluttered, right? You're not getting the information that you need based on the actual volume itself. you're basing it on candles and the expansionary move of a candle, right? Whether it's a higher or low of that candle that creates this longer move. So when I'm looking at this, right, this is a coded version of fair value gaps, right? Just look at this. Look at this and then compare it, right? This might not be the exact fair value gap, right? I'm getting scolded here. If I'm looking at this, right, and there's a bunch of fair value gaps on this chart based on a 5-minute candle, if I change it to an hourly candle, if I change it to a 2-hour, if I change it to a 30-second, 1 minute, whatever the hell it is, if it's going to generate different results, right, and it's going to generate different levels, it becomes a very arbitrary tool that doesn't have that much validity or edge in understanding where the market's moving, why it moved, how it moved. If I take the concept of a low volume node, for example, if I take the concept of a unfinished auction, if you talk about distribution theory, right? If I move this aside and we look at these auctions here, and you look at like a futures-based platform like Sierra Chart, for example, if you have low volume blocks, right, thin areas, these are ledges, these are distribution extremes that have low volume, realistically, those want to fill, and then you'll get an expansive move. There's none here right now, right? Okay, so here, for example, you have this low volume block, right, or this low volume block over here. It's at the ledge of a distribution, right? This is an area that was created by expansion. You want to go fill it to generate the continuous move to the upside, right? So if I'm looking at this, right, I generally like the concept of it, or I guess I agree generally with the concept of it in terms of an expansive move or in terms of like aggression to one end or the other. The only thing that is fairly arbitrary, and if you compare it to just a general volume profile or a market profile, is that it changes realistically based on the time frames that you're using, right? So from that perspective, if I'm using something that's based on volume in itself, right, or auction in itself, it doesn't change whether I'm looking at a 5-minute, hourly, 10-minute, whatever the hell it is. It doesn't necessarily matter. So that's kind of where it loses me, right? That's where it loses me in that. We got someone, Maximum Effort, just going full throttle in this chat. So this is why I'm trying to explain this, right? I'm trying to explain the viewpoint as it's explained online in terms of SMC. How, in relation to something that's based on volume rather than these arbitrary things, right? I see more value in something that's based on volume. So another thing is liquidity realistically, right? This is the third major concept that I found. And liquidity, right? There's breaks in structure and all that, but I'm just going to go over liquidity. Liquidity in SMC, from what I've seen and from what I've read, from what I've experienced, right, is used as a technical analysis area to identify where stops or stop hunts might happen realistically. So before the continuation of a move. So if you have like trend lines, support resistances, double bottoms, triple bottoms, double tops, all that nonsense, the idea of calling this liquidity and the machine or the algo taking your stops before it continues isn't really that concrete. There's no evidence behind it. You're just finding an area where you think that stops are hidden below, right? They can be, realistically. And the understanding of that without something concrete as order flow to understand who's stuck and who's not trapped there, it can either turn into a downside move or a head fake, right? You don't know unless you have more information based on that. So if I'm looking at this, right, and I'm trying to find, okay, stops or whatever, and liquidity zones where you're going to get a head fake before the continuation of a move or a reversal, realistically, it's not going to be based on trend lines if I'm day trading futures, right? I think for me, for a better analysis of the idea of stop hunts and the idea of head fakes is going to be based, again, more so on volume and the understanding of where order flow sits, realistically. So like today, if we have an expansive move and we open above a key distribution, we open above two major levels on the S&P 500. Yesterday, massive buying 5110, massive buying 5105. You rebid and you open above those levels and you open above the prior initial balance, right? You open above all these key big delta areas where a lot of buyers were piling in yesterday, thousands and thousands of lots of imbalanced buyers, when you open above those, realistically, there's a higher probability you'll have a trend day and you're just looking to get on board. The idea that above a high, below a low, above a trend line, below a trend line, that these stops are hidden, they're going to go hunt them and then they're going to go. Obviously, right, that's not the only thing. There's other concrete things that you have to add into this to make this thing valid, but the idea behind that doesn't sit too well with me because just plain technical analysis based on different patterns, right? So, in terms of those concepts, right, I don't necessarily see too much of the validity just based on a chart without something as consistent or concrete with volume. So I think there, when you talk about SMC, I think there's like some decent points and validity in terms of the concepts, but I don't think that they're, or the basis of them, the way that they're designed to work, right? The reasoning behind it is that concrete because it's a lot of chart work, realistically. I'm not saying it doesn't work for a lot of people or some people or whatever it is, but I think that if you start to increase the confirmation, the qualifiers behind a lot of these concepts with something that's actually proven, like order flow or volume, which is for me the best way and the most realistic way to understand how futures actually move, then I think that it loses a lot of that validity, realistically. So, those are my thoughts based on SMC. I think that, is there a defined edge? Not necessarily. Can there be a little more of a tweak to the concepts? Probably. If you start adding what real volume, real auction, real order flow look like, so you pretty much abandon that and just start looking at what order flow looks like. So those are my thoughts, right? I lean on the order flow side because it explains a lot of why things work the way they do. You're not supposed to sit there and think that they're hunting your stops. You're not supposed to sit there and think everyone's against you. You're supposed to sit there and say, okay, based on the unbiased information of the volume and the order flow of people actually trading, there's a high probability that XYZ should happen, right? Rather than, okay, depending on the chart that I pick, my gaps or areas to fill start changing drastically. These are things that I don't agree on. These are things in terms of these like slow markets that I think like auction theory and order flow has a better chance of actually continuously succeeding. So those are my thoughts, right? We have a plethora of comments, right? All engagement is good engagement. I feel like it's just, it's just, I feel like I haven't looked at them too much, but I feel like just back and forth. People on ICT side, people on no one else's side. I'm not here to talk crap, but I'm not here to talk crap, but I will. No. There's a lot here, and realistically, right? If you're that deep in the cult movement, go for it. There's no need to be here. You do you. Do you use WD GAN price and D time chart? Oh, geez, Joshua, I have no idea what that is. So no. Like I would say, look into auction theory, understand the concepts of how volume moves and markets move, right? And then compare it to what you know. Because realistically, right, there's a lot of things out there. And again, I don't want to go on a whole rant. I don't want to go and attack people, but there's certain figures in the industry that just it's a massive cult following realistically that doesn't have any validity, right? What I use for, if I look for trade entries and confirmation realistically, I'm using order flow, the DOM primarily, as well as volume profiles, right? You can look at a lot of the videos that we've posted based on volume profiles and how those concepts are to be seen and how they trade, especially with the DOM and how that order flow works. Like, like I said, right? I'm not here to talk non or like talk shit on people or like go after anyone, but realistically, when we talk about trading and we talk about specifically trading futures, if you don't have a hint of some kind of Wyckoff auction theory volume and order flow in it, you're most likely, right? Most likely not finding too much consistency. What? I can't listen to this guy. Sorry, criminal clickbait title should, or sorry, clickbait title should be criminal. What what in order flow do you look for in confirmation once price entry gets into your level of interest? That's a good question, right? Like this is a DOM. You've probably seen this DOM in many videos. You guys can find a lot of videos on this YouTube channel about DOMs realistically and how to trade order flow, how to trade the DOM in terms of order flow and what to look for, right? The thing with the DOM, what it shows like reactivity, market buyers and sellers. This is what real liquidity looks like, right? For those that are watching, if you want to understand what liquidity stops are, these are them. Imbalances, all that shit. So low volume, heavy volume. Here you can see it's a massive delta, right? Imbalance on the delta side. Market buyers enter, right? Net near 8,000. Prices can't go up and they reject multiple times, hitting on the offer, right? Big market sellers coming in. Reoffer, reoffer. What this is showing you is that these traders are stuck. And there's most likely going to be a flush of the longs, right? A new short position entering and a switch in market structure. You can see like my last longs had a few longs here. The last ones got stopped under this area on the trailer. I'm not sure at this I was doing this video, but the concept is you start running under these guys, right? You should probably get out of these positions if you're long or look for the short side. These are a lot of the things based on the confirmation that I look at. Do I agree that futures prop firms are getting out of hand? That's a very good question. There's a lot out there and you can have a lot of accounts. I can see the good and the bad in them, honestly. I think that there's positives and negatives. I think that a lot of the negatives are that uh, I think they enable a lot of gambling. They just enable YOLOing and just like going for it realistically. And they churn a lot of profit doing that, right? If Apex is able to pay out what is it like 100 million, I don't know what time span, but I just saw that number recently. There must be some truth to it, realistically. There must be something out there, but I think that they're really enveloping this industry and is changing a lot of how trading is done because a lot of these props, right? I might make a video on this, but a lot of these props, realistically, you're not trading real live capital, which is very, very different. Some of the positives are that you have access, theoretically, again, theoretically, you have access to make money, right? You have access to gain capital for a small investment, a small fee, right? If you do it properly and you do it slowly and you do it quantitatively and you don't YOLO, you don't tilt, you don't get aggressive, you don't no stop it, you trade it properly, right? And you're taking a few points at a time and scale up from there. The positives are you can mirror multiple accounts and you can have access to this for a fairly small fee realistically. And I know a decent amount of people that churn consistent profits out of this. So again, right, for people, I think a good positive is if you're actually a solid trader, a good trader, but you don't have much capital, right? Maybe you have okay capital, right? Maybe you got like six-figure account or something, which is solid capital. Maybe you got 50K, 30K. But you can't trade that much size, right? Maybe you're stuck on like three, four, five minis, and you're like I don't want to over leverage this. I don't have that much capital. I can build up on it, right? Maybe I do this prop for like 2, 3 months, generate a shitload of capital that's not necessarily mine, right? It's no one's for a smaller fee. I see some positives in that. In reality, yeah, it is a small account realistically, but growing a small account from like 5K to 100K is a very difficult game. The lower barriers of entry, as Purdue was saying, is like you get like 20 accounts, for example. I know some people that churn like 30, 40K a month out of these. Like it's not baby food, you know? That's another thing. I think another positive, like that's kind of what I was alluding to. Maybe I didn't say it properly, but Mike said you can use the prop to build up your own capital, right? If you don't have that much capital, like when I started trading, I obviously didn't have that much capital. I had to build it up without props, like over the past like 5 6 years or whatever it was. And this is it, right? These are my trades. I'm not the perfect trader, but up what, like 50 55 points on the ES today. It's not bad. I think it's pretty good. Some losses, some wins. Some stupidity trying to short this massive bull got my head out of my ass. But yeah, I think you guys are like there's truth to that as well, right? Prop firms are in no way for new traders or people who can't afford to lose money, right? Just like trading in general, I agree with that concept as well because a lot of people just churn and burn. You just unload the clip and you just like buy a billion accounts over and over again and you keep YOLOing them until something good happens without actually learning what to do, right? I understand that as well. But that's another thing, right? There's you have multiple different sides to this, right? You have a lot of different sides. Where's link for a BB Signal ICT Discord? Simple ICT. See them trade. Oh, by the way, trading live tomorrow. Check out. We're gonna be streaming on YouTube in the morning. Come see how they're gonna hunt my stops. I'm gonna have my stops on the screen so they can hunt my three lots like ICT. But like there's a lot of sides to these props, guys. Like listen, I'm in no way against or for them. I'm very neutral to them. I understand both sides of the situation. Someone in the comments was saying, they have 20 accounts, so, or their friend has 20 accounts, they just trade 1 mini and make bank. It's possible, people. What margin per contract do I think is reasonable? That's a good question. For minis, honestly, I like maintenance margin based on interactive brokers. That I think that's a good reference point, right? Between 5 and 10 grand per mini on the ES, right? I think that's fair. I think that's reasonable. Can you explain how to deal with the level of fake outs? Trades both and above levels before it picks direction. Fake outs, realistically, I see it from like a distribution order flow perspective based on like volume profiles and order flow. Like I kind of just wait to see if traders are trapped or if there's an actual offer before I start selling rather than let's say I have a level at 46 and I start selling 46 without seeing anyone sell it actually. If there's not a big sell at 46, then I'm probably not selling 46 myself. Listen, if I didn't short this shit on half the way up, I would have done a lot better today. This week, honestly, like from a from a transparency point of view, this was a very difficult week for me to trade. Honestly, I didn't have a like. It was solid in terms of P&L, but like it wasn't very good. Bro, I got liquidated out of these shorts like crazy. At least I wasn't shorting this whole way up. And that's what the reality of the situation is. I tried a few, I got blown out on them. That's fine. Anyways, the longs made up for stupidity on the day. And that's that. Trading into all-time highs and multiple sideways balances are difficult for me in general, especially with like fake moves in and outside of balance and like massive orders coming into. Catch them all. My trade levels are based on like a 50-day profile as well as individual session profiles, right? And a market profile. Oh yeah. Let's see how today wraps up, right? I'm probably gonna trade smaller size. I trade between like 2 and 6 lots on the minis, depending on the trade. But tomorrow I'm probably gonna be trading like twos. Um, we'll see how that goes, but that's what I want to do. Tomorrow we'll be streaming live, people, on YouTube, 9 a.m. Nas scalp god. I'm still long Nas. I had some Nas longs from this morning. That's actually paying. This is freaking shocking. But let's see how we do. Do I use bookmap? No, I don't. Um, yeah, I still trade options, people. I had swings on options from like Monday or Tuesday on Nvidia, Spy, Triple Qs. I just don't day trade them anymore, really. I day trade them here and there, but I'll swing the shit out of them. But yeah, I hope the guys at Vanta, if you see this, I'll see you guys tomorrow. Everyone else, have a great Thursday. Tomorrow's International Women's Day. Keep that in mind. Uh, Go and spoil and cherish the ladies out there. They deserve it. And I'll see you guys tomorrow morning, live trading room. Let's do it. Let's wrap up the week and let's end this difficult week realistically. So check us out at tradeproacademy.com. I appreciate you all jumping on here. Comments, good or bad, is engagement. So thanks, guys. Enjoy. And I'll see you tomorrow.